Ever wondered what separates the successful investors from the rest? The key could lie in understanding the smart money concept. The smart money concept, or SMC, is a financial theory that suggests that the big players in the investment world, the institutional investors, hedge funds, and savvy market veterans, possess superior market knowledge and trading skills that give them an edge over the average market participant. This concept is built on the idea that these smart money investors can identify and exploit market inefficiencies before the majority of investors catch on. Their actions, in turn, create patterns and indicators that can be used to predict market trends. At the core of the smart money concept is the principle of follow the money. This means tracking the actions of these sophisticated investors. Their buying and selling activities, their positions in specific markets, even their sentiments and opinions, can all provide valuable insights into market trends and potential investment opportunities. But how does one track the smart money? There are several ways to do this. One can look at indicators such as money flow indexes, which measure the inflow and outflow of money into a particular asset. Or one can analyze options markets, where large volume trades often indicate the actions of smart money. Another approach is to study market structure, which involves understanding how different market participants interact and influence price movements. By understanding market structure, one can identify the strategies used by smart money and align their own trading activities accordingly. Now, making money based on the smart money concept is not as simple as just copying the actions of smart money. It requires a deep understanding of market dynamics and the ability to analyze and interpret complex financial data. But the rewards can be significant. By following the smart money, one can potentially identify profitable investment opportunities before they become mainstream, thereby gaining an edge over other market participants. But it's not all roses. The smart money concept also has its drawbacks. For one, it assumes that the smart money is always right, which is not always the case. Even the most experienced investors can make mistakes and misjudge market trends. Furthermore, following the smart money can lead to herd behavior, where investors blindly follow the actions of others, leading to market bubbles and crashes. To sum up, the smart money concept is a powerful tool for understanding and navigating the financial markets. It involves tracking the actions of sophisticated investors, understanding market structure, and using this information to identify investment opportunities. However, it is not a foolproof strategy and should be used in conjunction with other financial analysis methods. And as always, it is important to conduct thorough research and due diligence before making any investment decisions.